heart of where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Scarlett Fu in for Caroline Hyde at Bloomberg's world headquarters in New York.
And I'm Alex Barinka in for Ed Ludlow in San Francisco. This is Bloomberg Technology.
Coming up, Nvidia's blowout forecast sparks a $260 billion AI rally. We'll break down the results and how to trade the red-hot technology.
And as a catastrophic U.S. default looms, we'll speak to one tech industry veteran who joined CEOs in signing an open letter to the president and Congress over their extreme concerns on the matter.
Plus, a $1.8 billion deal in the 3D printing space. We'll discuss why Stratasys is acquiring Desktop Metal with its CEO. All that and a lot more coming up. But first, we want to get you a check on the markets here at midday on this Thursday. And you have the S&P 500 moving higher by 0.5%, all thanks to technology. Look at the Philadelphia Semiconductor Index, higher by almost 6%, thanks to Nvidia's better-than-expected sales forecast. Alex will get into that a little bit later, but it's not as if all chip makers are rising. You actually have weakness in Intel and analog devices as well. There's a lot of angst over the debt ceiling and how little progress seems to be right now as we get closer to June 1st. You can see the yield on the 2-year moving up by 7 basis points to 4.45%. This is actually the 10th straight day that yields have been moving up, reflecting a persistent decline in demand for that security. Fitch actually put the U.S. on credit watch for a possible downgrade, even as it says it does expect some kind of deal at the last minute. Markets are also pricing in increased odds that the Federal Reserve will possibly raise interest rates at one of its next 2 meetings. Data is showing inflation remains fairly sticky. And in fact, the GDP report showed a faster rate of growth than what had been previously estimated. So with the U.S. dollar strengthening, let's change up the boards here. What you'll see is that commodities are lower, especially those priced in U.S. dollars, like New York crude, WTI off by 4% at the moment, snapping a 3-day advance. Saudi Arabia this week saying that people shorting the oil market should watch out, although that was followed up by Russia saying that it's unlikely OPEC and its partners, including Russia, will be cutting production in the near term. Gold futures also down by 0.9%. I bring this up only because I was reading somewhere, Alex, that one analyst said institutional investors, when they are looking for someplace to hide out, they hide out in gold. When individual investors are looking for somewhere to hide out, they go to Bitcoin. Right now, neither of these safe havens is catching a bid, but it's an interesting explanation of gold versus Bitcoin. Alex?
I'll get to some of those safe havens, Scarlett, but first I want to bring you to some of the red on the day. Snowflake is taking its biggest plunge in over a year. It reported disappointing sales outlook for the current quarter. That software company is known for charging customers on a pay-as-you-go model, but it told investors that the uncertain economic conditions have clients slowing down on using their products. Now, let's move into some of that green. Dish is surging the most in 6 months on a Wall Street Journal report that it's in talks to sell its new mobile phone service through Amazon. Now, Dish already uses Amazon's cloud to run core elements of the 5G network it's developing, but this move would give the company access to Amazon's millions of customers. Now into some of our bigger movers of the day. Microsoft is trading at a 16-month high. Investors are really on the hunt for the next AI trade. We've been talking about safe havens, and this company has been out front on that AI trade. It's not new news that Microsoft has been out front in AI. It's the biggest stakeholder in OpenAI and is already bringing artificial intelligence to its cloud offerings and its software. What is giving it a little bit of a lift today is perhaps a bit of the halo effect from the top stock I'm watching today, which I will take us to now. Let's go to Nvidia. I told you everyone's looking for the next AI trade. This is why. Nvidia's up a whopping 27% at record high levels and flirting with that big sticker $1 trillion valuation. The chipmaker reported a revenue forecast that surprised even the most bullish of analysts on sales of its processors used in, you guessed it, AI technology. It sells to customers like Microsoft, like Alphabet and others. Analysts at Susquehanna even called this the greatest beat of all time of any earnings report they've seen. This stock also could be benefiting from that safe haven effect we've seen in tech stocks lately. We'll dig into that shortly, but first I want to get more on Nvidia and that AI demand that's been booming. So let's bring in Bloomberg's Ian King. And Big report out of Nvidia yesterday. Lots of excitement on the forecast. Dig into the numbers here for us.
Yeah, I mean, they embarrassed Wall Street. The prediction of 11 billion, which would be their biggest quarter ever for the current period, 53% higher than where the average expectation was. And the numbers on the quarter were similarly a lot stronger. Even the paltry, long forgotten, nobody cares about PC business is looking better for them as well. It really just, wildly surprised everybody on the upside and gave investors exactly what they were looking for, which is like, show me the company that's actually making money out of this AI thing.
Yeah, it seems like it's hitting on all cylinders, Ian. How is it, when you zoom out a little bit here, that Nvidia always seems to be on the front lines of whatever the new hot thing in tech is? I remember super high-end video games, Nvidia is there. Bitcoin mining, Nvidia is there. And now AI, Nvidia is there.
Yeah, I mean, it's to hear it on a fundamental level from their CEO, we're talking about what he calls a shift in computing to accelerated computing. That's the idea that instead of using a type of chip that kind of does everything quite well, which would be an Intel CPU, you're using a chip for a very specific purpose that's really good at doing things in a very simple things relatively, but in a very parallelized way. So it's going to give a huge rush to, say, training AI software, or actually taking that software and doing the implementation of it, recognizing, cats in videos or what you're saying to your Alexa speaker, and making that much more efficient and much better.
Now, Ian, I don't want to damper on the day for Nvidia. They're having a big one, but this does make me wonder, when you think about the hyperscalers that it sells to, when you think about folks like Meta, a lot of those companies are known for wanting to vertically integrate their entire infrastructure stack. How long are Nvidia's processors kind of the belle of the ball? At what point do you see some of the customers actually pushing into creating their own silicon?
I mean, you nailed it, Alex. I mean, you wrote about it recently. This is absolutely the question that's hanging over them. And Nvidia has two answers to that. One is, we're going to run faster than they can because we've got a head start on this. We're good at it. And the second answer to this is, if AI is only the preserve of Microsoft, of Meta, of Amazon AWS, then that's not good enough. It needs to be a type of technology that every company that doesn't have these abilities can just walk into. So what they've been doing is making devices, is making cloud services and their own software that would help pharmaceutical companies, robots companies, automotive companies get into this. So they're kind of trying to hedge their bets there and stay ahead of the game.
Yeah, they've done a great job of staying ahead of the game. We've been talking about how Wall Street strategists like Michael Hartnett of Bank of America have talked about how there's this mini bubble in AI and a bubble in technology. Is there any acknowledgement of this in San Francisco, ground zero of all this technology, that perhaps things are getting a bit frothy?
Well, if you look at the inbox of any journalist, it's going to be full of pictures with the words AI in it. So what does that tell you? I mean, we've been through this before, obviously. But no, I think, Nvidia is a real good case in point, and the way the market has reacted is also a good case in point. Not every chip stock is up today. Intel is down, right? Mm-hmm. And some of the others aren't flying out. So I think there's a little bit more sobriety, at least in my sector. In terms of other areas, who knows? There's a lot of talk.
Yeah, well, Nvidia is delivering, and it is profitable compared to some of the companies in past moments of excesses. Ian King, thank you so much. Ian, with his decades of experience covering semiconductors in Asia and the U.S. Let's get more on the markets and bring in Mona Mahajan. She is Edward Jones's senior investment strategist. Mona, I know that you were listening to us talk to Ian just now. I'm curious, with the S&P 500 up 0.6%, clearly powered by Nvidia and these big tech names, but the Dow losing ground by 0.4% because it doesn't have that AI exposure. Is this overall a strong stock market or a fragile stock market, given how narrow the winners are?
Yeah, it's a great question, Scarlett. And look, this year the S&P broadly is up about 7% plus, but it has been very narrow leadership. In fact, only 3 sectors are outperforming the broader market. Those are, of course, technology, comm services, and consumer discretionary. So those growth parts of the market, quality growth parts of the market, some of those sectors are up 20% plus, so back in bull market territory. And meanwhile, the cyclical and more defensive parts of the market are lagging. So, as long-term investors, we would certainly like to see a broader participation in a market rally. That, to us, is a more healthy sign that the economy, the underlying fundamentals, and the market broadly has more room to run. Now, this narrow leadership, not only driven by a few sectors and a few names, but we're also seeing valuation expansion creep back into the marketplace as well. Keep in mind, earnings, although earnings growth this past quarter did exceed expectations, we're still looking at negative earnings growth and really now 3 back-to-back negative earnings quarters. So valuation is expanding. Breadth has been narrow. But what we will say broadly is that some of the reasons that investors have gotten back into the market, they do have this alternative sitting in cash and cash-like instruments, is because some of these technology players have provided a compelling reason to get involved.
Let me broaden out our conversation a little bit here, because obviously the excitement over Nvidia and any company that has ties to AI is papering over some weak spots in the overall market and the economy. Fitch, for instance, put U.S. on watch for a possible downgrade of its credit rating. Does it matter that it's Fitch versus S&P or Moody's, or is any one of the 3 big ratings companies downgrading the U.S. potentially enough for investors to have to sell? I'm just trying to get ahead of what we could see if the worst happens.
Yeah, it's an interesting question. And look, I think our base case continues to be that the U.S. does not default on its debt. And in fact, both sides of Congress come together in a negotiated resolution. We've seen some historic precedent for that. In fact, 78 times has Congress come together to raise the debt ceiling since 1960. 20 of those times have been since 2011, and 6 of those have been in using extraordinary measures. So there is precedent for this, and we do think that will be the most likely path forward. But in the meanwhile, we will certainly get consternation, and the Fitch warning is certainly one signal of that. We would say if, in that tail risk scenario that the U.S. does default, any of the rating agency downgrades will be meaningful. And not only that, we will have broader impacts on equity bond markets, but also things like payments to, key areas of the economy, Social Security, Medicare, defense, et cetera. So there are real meaningful impacts of not only the downgrade, but the default itself. But we're still hopeful that, as we approach the X date, really both sides can come together, and both sides will probably have to concede to some extent, but we'll get that negotiated resolution.
Mona, if we do have that, as you say, kind of outside case of default, even if we don't, some economists are saying that this whole back and forth could push us into something of a mild recession. If that does happen here, where do you rotate your investments? Is it back to cash? What are you looking at if that is kind of the scenario we see over the next 12, 18 months?
Yeah, look, I think certainly the mild recession scenario is one that is now somewhat baked into markets. In fact, if you look at the Bloomberg consensus estimates, Q3 and Q4, 2 back-to-back quarters, they are looking for negative or calling for negative GDP. It's minor, negative 0.5%, but still sub-zero GDP for 2 quarters. And that is now probably the most well-advertised mild recession on the horizon. If we do get more meaningful volatility around the debt ceiling, that could create, just feedback loops around the consumer pulls back. There's hesitation to invest even in safe haven assets. And that does have an impact and a ripple effect through equity and bond markets. We'd say in that scenario, you certainly want to be more defensive. And in that scenario, defensive probably still means areas of the market like staples, healthcare, utilities, but also still overweight some of those cash and cash-like instruments. So that kind of barbell between the equity and the bond market on the defense side. Now, as we do, if that does not occur and as we do get through a resolution and the economy goes through a mild recession and looks towards recovery, that's when really we think about a more broadening participation, as we talked about earlier. That recovery playbook should include leadership from areas like small cap stocks, like international EM equities, and also, of course, longer duration bonds and cyclical parts of the market. So not just tech leading the way. We do think as we look towards the back half of the year and towards a potential recovery, we'll have a more sustainable, broader leadership in the market as well.
I have to ask one last one on tech. We did see during the pandemic era, the tech, particularly big tech, was really gaining, particularly on digital advertising strength, e-commerce. But when that kind of time period ended, investors turned back to the fundamentals. Cost structure was in play. Fundamentals of these companies were in play. Is there a risk here for these big tech names that are really getting a lot of love these days from the equity markets that if we have a quarter of maybe shakier fundamentals, that you could see a big sell-off in that sector in particular?
Yeah, look, there's certainly a case to be made and a credible case that we're getting into overbought territories, and a pullback and period of consolidation, we think, probably is normal, would be normal, healthy in some cases, given the excess moves that we've seen. That being said, in an era of low growth, low economic growth, investors do tend to gravitate towards higher growth parts of the market, especially those with defensible business models, strong free cash flow, and those that are returning value to shareholders through buybacks. So there is, perhaps a little bit of consolidation volatility ahead, but the long-term picture, we think, looks a little bit more balanced and still healthy for technology.
Mona Mahazan, thank you for taking us through today and in the future. That's Mona Mahazan of Edward Jones. Appreciate you joining us. And coming up, we'll speak to the CEO of Stratasys after the company inked a $1.8 billion deal with Desktop Metal to combine. More next. This is Bloomberg.
All right, in the 3D printing world, Stratasys agreed to acquire Desktop Metal. It is an all-stock deal that'll create a leading company in the industry, valued at about $1.8 billion. Joining us now is Yoav Zeif, Stratasys CEO. Yoav, thank you so much for joining us. Your company recently rejected a takeover offer from rival Nano Dimension, yet here you are getting ready to buy Desktop Metal. Why does this particular combination make sense?
Because it will reshape the industry. The 3D printing industry or additive manufacturing for years is failing to deliver what manufacturing really needs. But with the combination, we'll create the scale to deliver.
And with that scale, are there certain clients or certain slices of industry that you think you can really sell into now that you're pulling in this additional functionality with this acquisition?
Definitely. We are leading in the aerospace and automotive markets. And we are also leading in dental and medical, but we didn't have the metal part. We are focusing on polymer. Now together, we are selling to the same customer through the same channels, a much bigger portfolio, broader portfolio, and we'll be very profitable to leverage our scale.
Yoav, you say profitability. Talk to us. Day one, what is the financial impact on Stratasys from bringing this company in the fold? Are we talking an immediate revenue boost? Is there margin accretion? Kind of talk us through the financial side of this acquisition.
Great question. We are the only profitable, Stratasys is the only profitable business in the 3D printing arena. Desktop Metal announced that they will be profitable by the end of the year. When we combine us together, we'll be the first above $1 billion company in this industry. This is huge. In 2025, we'll sell $1.1 billion with EBITDA margin of 10 to 12%. This is something that does not exist today in additive manufacturing because we are not mature enough.
Yet, and I appreciate your pointing out that you are profitable and you're a leader in that space. 3D printing seems to be a pretty fragmented space right now. Give us a sense of who, once you combine with Desktop, you'll be able to better compete with now, even beyond the 3D printing ecosystem.
We will be better equipped to compete with the entire, second, third, fourth, fifth, because we are number one. And the main reason is the broadest portfolio, unmatched material portfolio. Material and software is key in our industry. And those are also the ones that generate the profit. So when we are coming to customers, we have two huge advantages. One is that we are selling him whatever he needs, not what we have, because we are covering the whole technological space. So we are not selling what he needs, we sell what he needs. The second thing is that we have a full solution, including the material and the software, so the customer does not need to look outside our platforms.
Another advantage you could have or you could tap into is the shareholders of Desktop. Desktop Metal went public in 2020 through a SPAC, and one of its biggest shareholders is Alphabet with about a 3% stake in the company. Do you anticipate working more closely with Alphabet as a result of this transaction?
No doubt that we can benefit and cooperate with the great shareholder base of Desktop Metal. It's a group of people that believe in innovation. Desktop Metal is bringing the innovation to the table, but we are bringing the establishment, the go-to-market, the infrastructure to make this innovation a real product that delivers values to the best marquee customers in the world.
You say you'll look to them for help on innovation and bringing that innovative spirit. What specifically are we talking about when you think about the Alphabets of the world and how they can kind of lend some of that innovative spirit to you as well?
Desktop Metal are located in Boston. They are highly linked to MIT, and that tells the entire story. It's so hard to find talent in our industry, and the ability to have great links in the academia, plus great shareholders that are interested in breakthrough technologies, I think it's a great way to take forward.
Well, thanks for walking us through this acquisition today, Stratasys CEO Yoav Zeif. Appreciate you joining us. More coming up. Microsoft is pushing back. It's formally filing to appeal the UK's decision to block its mega merger with Activision Blizzard. More on that next. This is Bloomberg. And keeping our eyes on shares of Splunk. The software company reported first quarter revenue that beat expectations and gave a second quarter forecast that's ahead of the consensus estimates. The shares are coming down on the days. They were up this morning, now right about unchanged. We'll continue watching throughout the show. This is Bloomberg. It's time now for Talking Tech. First up, Grab's co-founder is stepping down from her operational roles at the company by year's end. She helped start the Singapore-based ride-hailing and food delivery company more than a decade ago and currently leads its technology and corporate strategy teams. Tan will also give up her seat on the board, though she will remain an advisor to the company. And Microsoft President Brad Smith says the U.S. should make a new agency to regulate artificial intelligence and the licensing requirements necessary to operate those AI tools. Smith outlined the company's policy regarding AI and echoed sentiments from OpenAI's Sam Altman, saying that government oversight, quote, will ensure that humans remain in control of the technology. And in other Microsoft news, the company has formally filed its appeal against the UK's Competition and Markets Authority after the antitrust agency blocked its $69 billion deal to buy Activision Blizzard. The CMA says it stands by its decision, arguing it would enable Microsoft to set the terms of the gaming market.
And sticking with video games, look at shares of Nintendo over the last few weeks. It took just 3 days for the latest installment in the Legend of Zelda franchise to sell more than 10 million copies worldwide. 4 million of those were in the Americas, where the new game became Nintendo's fastest-selling game ever. From New York and San Francisco, this is Bloomberg.
Welcome back to Bloomberg Technology. I'm Alex Brink in San Francisco.
And I'm Scarlett Fu in New York. Let's get a check on the markets right now because the Nasdaq is flying high at the moment thanks to Nvidia's blowout sales forecast on the back of demand for its AI chips. And you look at the New York FANG index, in which Nvidia has the biggest weighting, a 13% weighting. It's flying even higher, up more than 3%. And of course, let's look at Nvidia itself, gaining more than 25%. And in fact, there's a great story on the Bloomberg that traders betting against Nvidia have suffered massive losses. We're talking about a $2.3 billion paper loss just today alone because of its big spike higher. Now, on the downside, you have the ETF that tracks shorter duration treasuries. We're talking 1 to 3 year maturities. It is down for an 8th straight day, the longest losing streak in 19 years, believe it or not. When there's a sell-off in bonds, yields go up, reflecting the increased payouts that investors demand to buy the securities. And that's where I want to go next because, of course, the debt ceiling drama dominates even as the market overall is higher today. Take a look at this next chart. It is a snapshot of the U.S. government's checking account. This is the amount it has on hand to pay its bills, whether it's paying interest on its debt or sending out Social Security checks. As of Tuesday afternoon, it had about $76 billion. That moved higher in mid-April, which you can see that little blip in the last part of the chart was a result of people and companies paying their taxes. Treasury Secretary Janet Yellen has identified June 1st as a date the government may run out of money to honor its obligations. According to economists at Goldman Sachs, this cash level that we're looking at here will drop below $30 billion by June 8th or June 9th. That is seen as the bare minimum for meeting federal obligations that come due, Alex.
Well, as those negotiations in Washington over the U.S. debt limit persist, the risk of defaulting for that first time is growing. That's why more than 140 CEOs and Wall Street executives have been sounding the alarm bells. In a letter to the president and congressional leaders, the group writes, quote, high inflation has created stresses in our financial system, including several recent bank failures. Much worse will occur if the nation defaults on our debt obligations. We strongly urge that an accord be reached quickly so that the country can avert this potentially devastating scenario. Joining us now with more insight is Charles Phillips, managing partner and co-founder of Recognized Partners. He's also one of the many that signed that letter. Now, Charles, that letter was sent May 16th. It's been a few days since then, and we've had headlines cross, like Speaker Kevin McCarthy saying today, quote, I don't know if we'll have a deal today. He also said yesterday they need 72 hours. They're going to take the 72 hours to review and pass any bill that does come through. How has the urgency changed since you and your fellow CEOs and leaders wrote that letter just a little over a week ago?
Well, there's a reason the markets are starting to react. You can see the credit default swap spreads are changing, and there's plenty of indicators out there. So it's gotten more urgent. It just so happens that Recognized, we own a bunch of technology companies who had our annual meeting this week. So all of our companies were in, all of our investors were in. And normally you talk about technology changes, valuation, operational improvements, and now we have to talk about this. We just went through a banking crisis, wondering, kind of cost of credit. We had some SVB problems and FRB. We solved those, and now we have to deal with this. Will your cost of capital be higher in 6 months, in 3 months, in a month that you know about? So the planning aspect of this is wreaking havoc on people, and so the uncertainty is the thing that people don't like dealing with right now.
So that's interesting that you've been having these meetings and it keeps coming up. How are some of the leaders and the executives planning around this or through this?
Well, fortunately, we don't use a lot of leverage in our portfolio. We have some companies, but it certainly made us think differently about it. Don't count on that because we don't know what the cost is going to be. We may have to use more equity, but not everybody has that leeway to do that. So that means perhaps fewer deals get done or to get done at a different price. The second thing is we rely on certain state and local government budgets. So we have companies that sell into that market. With the slugs window closed, they can't fund the infrastructure spending that they normally rely on. We need those state and local governments to be spending because we have companies that rely on those contracts. So it has implications that ripples down to the state and local level as well.
That's really interesting. It's something that perhaps a lot of lawmakers in Washington may not be immediately aware of. In your current role, you're obviously around entrepreneurs all the time. You're learning about new technologies from them, in turn helping them think through strategies, recruiting, connecting with customers. What do you think Congress and the White House as well don't fully understand about how their actions reverberate in the private sector?
I think they don't understand that the U.S. brand around the world accrues to each one of our companies, that we're viewed as understanding business, very innovative, but coming from an economy that's rock solid, that is risk-free treasuries, and that we have fiscal discipline. And so we all kind of benefit from that brand. When you start to question that a bit, well, okay, you're no different from us, you get a certain patina around that. And that people believe that we know what we're doing because we're from the U.S. And so the brand aspect of that, I think people don't quite understand that it hurts all of the companies.
Charles, that reputational risk is really interesting. I'm curious with you as an investor yourself at Recognize, does that reputational risk of these kind of chaotic conversations, of the banking crisis that's gone on with some of the important funders of places like the tech sector, like SVB, does that reputational risk pose some challenges for you as you're looking for your growth investments going forward?
Sure. So we're competing with other investors around the world. And so we want to look like we have an edge. Part of it is we have an operational background. Part of it is we're from the U.S. And part of it is we have a lower cost of capital. And so any one of those things that starts to break down, you look not as strong as you would otherwise. And you don't want people asking the question in the room, what's going on over there? And so I just think the implications for the job market in general, if we can't pay our bills, Social Security, or whether it's our military or whatever, these things start to break down. It just looks like chaos to everybody. And so I think people thought that this couldn't really happen. Maybe they're playing a game of chicken, but they always work it out. But now you never know because things have gotten so partisan. It could actually happen. And so that's what's different now is people say this could be a real thing that happens.
So then do you start looking geographically to regions outside the U.S. where the companies aren't sitting in a room and having to cope with uncertainty or kind of a pause in really innovative strategies because there's too much chaos potentially looming for the economy here in the U.S.?
Well, we've always been global, so we have companies in Ukraine, Latin America, all over the world. And so, but relative to where we could be investing, does it make perhaps the U.S. look a little less attractive than it would otherwise? Sure, but that's like any global investor. So that's everything. Capital can flow anywhere these days.
You served on President Obama's Economic Recovery Board. You also served on the board of the New York Fed. So you've seen the fallout from political intransigence and also been in rooms with policymakers to discuss the economy. How do you think the 2023 debt ceiling standoff differs from what we've seen in the past? Or is this just business as usual to some extent?
This one seems more severe. It was shorter back then in 2011, but we still lost $2.4 trillion in market cap, $1.3 billion in extra interest costs. So it had implications. This could go on longer because the size of it is so much larger. And we had certain faith back then that people had to work it out. They didn't want Armageddon to happen. We're not sure of that right now, so it makes it seem worse than it is.
Charles, thank you for breaking down those private sector implications of us for us. Thanks to Charles Phillips, managing partner and co-founder of Recognize Partners. Still coming up, the impact of generative AI on retail. We'll discuss all that and more with the CEO of Buy Now, Pay Later platform Klarna. Next. Speaking of Buy Now, Pay Later, we're also watching shares of Best Buy. First quarter profits topped estimates, and the company reiterated its annual target. Best Buy CEO views this year as the bottom for the decline in tech demand. This is Bloomberg. Let's now take a look at the future of retail, which could be more personalized and tech-focused in the context of the generative AI revolution. At least that's a projection laid out in Klarna's new Future of Retail report. Klarna CEO Sebastian Szymianowski joins us now for more on this. Sebastian, you are looking ahead to how people are going to be opening their pocketbooks. How will AI really start to show itself in terms of where people are spending in retail?
Right. I think first and foremost, I tried this my first in November when it got, started trending on Twitter or whatever. And I was like, what's this thing? And I got to tell you, it was magic to me. I felt like when I opened the internet the first time 20 years ago. So I think it's, super impressive. I instantly got in touch with Sam and I said, look, I want Klarna to be your favorite guinea pig over at OpenAI. You throw it at us, we'll try it, we'll learn. And I think that's the way to deal with these things. When you see a dramatic shift like this, you just want to learn, iterate, and understand it. And I even coded myself on the LangChain the other day, so I feel quite cold. Never done that before. It was one of my biggest regrets. I never became an engineer. With that said, look, I think what's very clear here is that the tool is out there. The applications that are really changing things are not yet, but they're going to come. In the next 6 to 12 months, we are going to see better shopping experiences, shopping assistance, providing you a higher conversion rate for the retailers, assisting consumers to find better prices, better offers, etc. So I'm expecting to see an explosion of new tools and services coming in the next 12 months, which will utilize this technology to provide a much richer and more accurate experience for consumers. So super, super interesting to follow. And also there seems to be, as the study shows of ours, a huge big opening among consumers. They're willing to try and test these things, and they also believe that it can make a difference for them.
When I think about kind of the evolution of retail, we had kind of the malls start to bring things together on a regional basis or a town-based basis. Then we had online shopping where you could buy anything from anywhere. Then the e-commerce players showed up. But that's kind of evolved to this world where you almost have too much choice, right? If you log on to any of the e-commerce platforms, it's almost hard to narrow down if you don't know exactly what you're looking for. So is that kind of a problem that you expect some of those early applications might be a really kind of low-hanging fruit one to solve when it comes to bringing AI in, perhaps to help folks discover things based on their own preferences a little bit more easily?
I think you're totally spot on. Look, remember when you were living in, like I did, in a small city of 200,000 people growing up there was one department store and they had very nicely curated everything we needed to buy for us. So everything was there and we didn't need to look elsewhere. And nowadays you're overwashed with all this stuff. But I think in general, you should think about retail as three things. You think about the products and the brand themselves. you think about the curation, and then you think about the technology and the logistics to bring the product to the consumer at the time they want it and at the right price and so forth, right? And I think on the curation side, internet has gone crazy, right? We've seen everything from Instagram shopping, shoppable valuables, Instagram people trying to affect you to or influencers recommending products, but also obviously the retailers and the brands themselves trying to curate. I think the curation, to your point, is one of the areas that is a huge opportunity to offer better curation. We launched search in the US. I mean, there's been nobody launching search in the US against Amazon for the last 15 years, and we're seeing tremendous traction to reinvent product search. Just like these things, right? How do you both intent-driven discovery, where you're looking for the exact right product at that right price, etc., but also the kind of inspirational. That's definitely an area where I think, and curation is so critical. I want it to be personal to me, right?
Yeah.
China is a good example of that. In China, it's nowadays, it used to be 80% search, 20% was recommendations by AI. Currently, 80% of what people buy on Tmall, etc., are recommendations by AI that are specific to me as an individual and not search anymore. So that just shows you what this technology can mean as a shift.
Yeah, and certainly making things more efficient in the process. Google CEO wrote in an op-ed recently that building AI responsibly is the only race that matters, as opposed to building up your AI chops. And he also brought up regulation there, too. What are you seeing as some of the potential problems or pitfalls or areas that might be concerning that would result from the use or integration of AI in shopping, for instance, in your world?
Well, I think as also, since we're a payments company, obviously fraud is a big aspect to us, right? And we can see that this is going to have implications on fraud protection. I think there's a lot, I think on a societal level, as a society, and I respect that a lot when I speak to people, tech leaders. I am very happy to hear them not only promote the amazing opportunities that this presents, but also kind of highlight the risks, and that we treat this in a mindful way. But that's more from a society perspective. If I think more of my business, I think there's one critical thing that could actually make a huge difference from politicians. In some markets in Europe, Sweden is a good example where I'm based currently, we have an electronic identification that is available to everyone. Everyone has it on the phone. That means there is no fraud. There is no problems with people pretending to be somebody else. There's much less fraud than in many other markets that we see. It's a simple thing, a digital passport, a digital identification. And I think another law that we should expect to see is, if I interact with something, I want to know if it's a computer or a human. I think you have the responsibility to be very, very transparent about that. So I think those are two very simple things that could actually mitigate some of the early risks and changes that, to your point, AI will bring.
There are people who are out there who might say that Klarna is pivoting towards AI and a commitment to AI as regulation comes forth on buy now, pay later in Australia, for instance, and potentially in the UK as well. How would you respond to that?
Forget it. No, but I think that buy now, pay later is a fantastic credit product for consumers. Because everyone should watch, sorry to make some marketing here for somebody else here, but you should watch Credit Cards Explained on Netflix, and you get a 25-minute quick summary of all the bad practices, of all the stuff that banks have been doing with credit cards, how they really try you to build up the biggest balance, to revolve on it on the longest period of time. I mean, the average balance in the US right now stands at $5,300 compared to $150 for our buy now, pay later products. So I think that it's interest-free, it's fixed installments. We don't push a credit limit in your face to try to make you believe that you can spend more than you have. I mean, we're trying to build a responsible credit product. No, it's still credit. So obviously, credit has risks in itself and needs to be offered in a responsible way. But as a credit form, it is superior to the credit cards. And it's actually also better for us in an uncertain economical environment, because we underwrite every transaction. That's why we're seeing 40% below credit card industry standard losses. Because when we shift our underwriting, it takes me 2 months, and half of my balance sheet is underwriting on the new methodology. So I can really quickly change to an economical environment like this one, while banks will wait 2 years before they see the shift in their balance sheet due to the changes in underwriting.
Sebastian, I want to ask one more quick one on AI, because we've been talking about that. The race is on. The race is probably also on for talent. I know you jumped in really quickly to work with OpenAI, but what does hiring look like internally at Klarna? Where are you finding kind of the individuals who can make sure that that type of technology can be seamlessly tested and integrated into what you're rolling out for consumers?
You know what? I think it's obviously an important question. And obviously, data scientists and so forth are in higher demand. I wouldn't say that's the case, but I also want to get, again, how much this is just about, curiosity and encouraging people within your culture to innovate and to try and to test. One way that I measure right now Klarna's AI involvement is we offer all of our employees a ChatGPT-4 powered OpenAI account. And we're just looking at how many are actually using it. And I think right now we're at about 1,500 among 5,000 employees. I want to get to 5,000. I want each one of them to experiment and learn how to utilize this technology. I mean, it took years for people to really discover the power of Google back 20 years ago and how much that could, save you time and make you more efficient and more productive. So, I think also, one shouldn't underestimate just encouraging and inspiring people internally to adopt, to iterate, and try.
So it's about experimenting and engaging right now before we can draw any big conclusions. Really appreciate your joining us. Sebastian Siemiatkowski, the CEO of Klarna, joining us from Stockholm at the moment. Now, coming up, we're coming back here to the U.S. because Ron DeSantis' campaign announcement on Twitter was beset by technical glitches. More on that next. This is Bloomberg. And as we head to break, keeping an eye on shares of Palantir after the company and Ukrainian officials said they will deepen their relationship to help power the country's reconstruction efforts, with an emphasis on reestablishing schools in war-torn areas. Palantir has been working with Ukraine since last year, providing software as well as incorporating AI technologies to power battlefield decision-making. Florida Governor Ron DeSantis' live event on Twitter was marred by technical glitches, with servers struggling to handle the demand, and led to his announcement being hosted on venture capitalist David Sachs' account instead. Sachs was moderating.
That was insane. Sorry. We actually doing this from David Sachs' Twitter account because it looks like doing it from mine basically broke the Twitter system.
Joining us now to break down the launch of DeSantis' presidential run on Twitter is Bloomberg's Sarah Friar. Sarah, how much of this technical train wreck can you tie back directly to Elon Musk's staff firings and various cost cuts?
Well, they don't have a lot of the people that they used to have who were working on this kind of infrastructure stability. They got rid of use of a data center that they had in Sacramento, which increased the stress on their systems, and they've been making product changes. So those factors, plus the fact that they didn't really prepare for this moment, it seems like they didn't stress test their systems, or this wouldn't have happened.
Now, I was tuning in yesterday, and Elon Musk said hopefully this can be a platform with people of divergent political views to exchange those views. I have to ask, though, in the course of that conversation, did they put diverse political views on display with this Ron DeSantis announcement?
Oh, absolutely not. It was questions by people who were favorable to that campaign. And listen, this could blow back on Musk and Twitter's business because historically, social media executives have not tried to align themselves with a particular party. They've tried to be neutral because what they're trying to do is have the widest possible user base and the widest possible set of advertisers who want to spend money reaching those users. And if Twitter positions itself as, we are more friendly to one political party over the other, then I do think that some advertisers will shy away from that. But I did see the new CEO, Linda Yaccarino, in the room. She was there.
She was there. And so were you.
She could fix it, maybe. We'll see.
Thank you, Sarah, for wrapping that up for us. Thanks to Bloomberg's Sarah Friar. And David Sachs will be joining Bloomberg TV in 30 minutes to talk about this more. That does it for this edition of Bloomberg Technology. Don't forget to check out the BTech podcast. You can find it on the terminal as well as online on Apple, Spotify, iHeart. And this is Bloomberg.